Tesla has always been a master at pricing strategy, whether it's cutting prices to boost demand, raising them to protect margins, or adjusting leasing terms to capture new buyers. Tesla knows that how much it charges is just as important as what it builds. But in 2025, a major shift has landed. Tesla has raised lease prices across all of its U.S. models, right after key federal EV tax credits expired for many versions of its cars. So the big question now is simple. Will Tesla's demand crater, or can the company ride out this pricing storm? Let's start with what happened. For years, federal tax credits have made EVs more affordable in the U.S. Buyers could qualify for up to $7,500 in credits if their vehicle met certain requirements for assembly and battery sourcing. Tesla, along with other automakers, leaned on those credits to bring down effective monthly payments and expand its customer base. But in early 2025, new Treasury Department rules kicked in, tightening the requirements for sourcing critical minerals. Several Tesla models, particularly versions of the Model 3 and Model Y, no longer qualify for the full credit. Practically overnight, many buyers lost a big financial incentive. And Tesla's response wasn't to lower prices, it was to raise lease payments. The hikes vary by model, but across the lineup, monthly lease costs jumped by roughly $50 to $100. On paper, that may not sound massive. But for price-sensitive buyers, especially those choosing EVs because they were finally affordable, it's a significant hit. Leasing has been one of Tesla's strongest tools to expand demand, because it lowers the upfront cost barrier. With leases now more expensive, some customers may simply look elsewhere. So why would Tesla raise prices at exactly the wrong moment? The answer lies in margins. Tesla has been under pressure for years as it cut sticker prices to compete with new EV entrants from Hyundai, Kia, Ford, and Chinese brands abroad. By late 2024, Tesla's profit margins had fallen to their lowest level in years. Raising lease costs is one way to restore some of that lost profitability. Remember, leasing isn't just about monthly payments. Tesla retains ownership of the vehicles and can resell them later, creating a secondary revenue stream. By charging more upfront, Tesla protects its bottom line. But here's the risk. Demand. For years, Tesla could rely on near-endless demand for its cars. Now, the EV market is more crowded. Buyers have choices. Stylish options from Hyundai and Kia, affordable crossovers from Chevy, luxury entries from Mercedes and BMW. If Tesla pushes its lease payments higher while tax credits vanish, some buyers will shift to competitors. Already, analysts are warning of slower sales growth in 2025 compared to the breakneck pace of previous years. This raises a bigger question. How much of Tesla's demand was built on price cuts and incentives, and how much is truly brand loyalty? Tesla fans remain passionate, and the company's charging network and software still give it a major edge. But in a more competitive landscape, price matters. And right now, Tesla's affordability advantage is slipping. There's also a geographic dimension. In states like California, New York, and New Jersey, local incentives still help offset the loss of federal tax credits. But in much of the country, those incentives don't exist. For middle-class buyers in states like Texas, Florida, or Ohio, the lease hike could be the difference between signing on the dotted line or waiting another year. That could slow adoption just as the U.S. is trying to push EV penetration higher. Meanwhile, competitors are moving aggressively. Hyundai and Kia continue to undercut Tesla with attractive pricing and strong lease deals, even though some of their models also lost tax credit eligibility. Ford has refreshed its Mustang Mach-E with longer range and lower lease offers. GM is rolling out the Equinox EV, one of the most affordable electric crossovers on the market, and advertising aggressively that it qualifies for credits. If Tesla's pricing looks less competitive, buyers may jump ship. On the flip side, Tesla has some unique advantages that could soften the blow. Its supercharger network is still the gold standard in the U.S., and with competitors like Ford and GM adopting Tesla's charging standard, the network's dominance is growing. That infrastructure alone may convince some buyers to stick with Tesla, even if it costs more per month. Tesla also continues to lead on software, over-the-air updates, and features like autopilot and full self-driving. For tech-savvy buyers, those perks may outweigh the higher lease costs. So where does this leave Tesla? The answer depends on the balance between brand strength and consumer price sensitivity. If Tesla's core customers are loyal enough, demand won't collapse. It will simply level off. But if buyers start prioritizing value over brand, Tesla could face a demand dip at exactly the wrong time. There's also the strategic question of timing. By raising lease costs now, Tesla may be preparing for its next big product cycle. The long-delayed Cybertruck is finally ramping up, and Tesla is expected to unveil a next-generation, lower-cost EV by 2026. If those new models arrive with competitive pricing, today's lease hikes may be a temporary hit to preserve profitability before the next wave of demand. Still, the risks are real. EV adoption in the U.S. slowed in 2024 after years of rapid growth. Some analysts already warn of an EV plateau, where adoption stalls before the next technology breakthrough, likely solid-state batteries. If Tesla adds cost pressure on top of that, the company could find itself facing demand headwinds even as competition accelerates. Here's the bottom line. Tesla's decision to hike lease prices right after tax credits expired is a gamble. It helps protect margins in the short run, but risks alienating price-sensitive buyers in a crowded market. Demand won't crater overnight. Tesla's brand, charging network, and tech still carry huge weight. But the days when Tesla could raise prices without consequence are over. In 2025, affordability is king. And if Tesla wants to stay ahead, it may need to do more than lean on its brand. It may need to rethink how it balances profitability, incentives, and customer loyalty in an EV market that's more competitive and less forgiving than ever before.